Hey everybody, my name is Amin, and I'm one of the owners of AminTradingGroup. And today I'll be talking to you guys about the basics of a call option versus a put option. I'll show you an example in the S&P 500 ETF, otherwise known as SPY, and then I'll show you in Roku also. And then I'll talk to you guys about the Greeks, and then that's it. For this video, I'll take two different stocks that I really like. I like the S&P 500 ETF. Which is SPY, and then the other stock that I really like is Roku. So I'll show you how to buy a call option and a put option for both of them. So first, you want to first get to the trading panel. So, SPY, click on SPY, which is the first one. It'll bring you to the screen. On the right-hand side, this is where you buy the stock. Underneath it, where it says Trade SPY Options, that's where we click on. So Trade SPY Option. And then once you do that, it'll bring you to the trading panel. I'm just going to talk to you guys about what the different buttons are real quick. So we have the buy, we have the sell. You can toggle between them. You have the call option, and then we have the put option. And then on the right-hand side, we have the expiration dates. So for SPY, the closest expiration date to us is the 26th, which is on Friday. One thing to keep in mind is SPY is the only stock ever to have 3 expiration dates in a given week. So looking at next week, March 1st, March 3rd, March 5th, SPY has 3 different expiration dates in a given week. So Monday, it's the 1st, Wednesday, it's the 3rd, March 5th, it's the Friday. And other stocks, like let's say Roku, they only have an expiration date once a week, which is on Friday. So let's say, we're going to change this to the 26th, which is this Friday, and we'll be looking at the call options and the put options for the expiration date of the 26th. So a couple things to get into, when you first start trading options is, you need to know the difference between a call option and a put option. So a call option is you're very bullish on a certain stock, while a put option is you're very bearish on a certain stock. So when you buy a call option, you want the share price to go up because you are bullish on that stock. And then when you buy a put option, you're bearish and you want the share price to go down. So first, we'll be looking at a call option. And to understand what a call option and a put option is, a regular option contract is a contract between a buyer and seller that gives the buyer the right to buy 100 shares of an underlying stock at a given strike price on a given expiration date. So, we talked about the buy and sell, we talked about the call and put, we talked about the expiration date, and then on the actual panel, we have strike price, break-even price to break-even, percent change, and then price. So these are the strike prices on the left-hand side. This is the share price in the middle. So currently SPY is trading for 392.58. And then, on the left-hand side, we have 393, 394, 395, 392.5, 392, and etc. Over here on the right-hand side, these are the premiums. So these are the market prices for what you would pay to own one contract at a given strike price. So $1.25 for 393, $1.49 for 392.5, and so on. So when we're looking at a call option, the first thing you need to understand is what's the difference between in the money call option versus out of the money call option. So when you're looking at in the money versus out of the money, anything out of the money is anything higher than the share price. So the current share price is 392.54. Anything out of the money would be considered 393, 394, 395. Anything in the money would be considered anything below the share price. So 392.5, 392, 391 is in the money. So in the money is over here, out of the money is over here. And what's the main difference between in the money versus out of the money is out of the money contracts are going to be cheaper but they're going to be more riskier. They're more affordable, but they're going to be way more risky. And in the money contracts are much safer because the premiums don't burn off as much, but they're more expensive. So, as you get further and further in the money, as you can see, the prices are increasing to own one contract. But as you get further and further out of the money, the premium prices are decreasing. So, if you ever, can't afford a contract for a certain stock, and you have to buy out of the money, I recommend that you only stick, maybe 2 or 3 out of the money, 2 or 3 strike prices out of the money. Don't go too far away because, the contracts are going to start bleeding if it doesn't go your way, and you'll lose a ton of money. So let's say before the 26th, you're very, very bullish on SPY and you think it's going to keep on going up, and you want to buy a call option to take advantage of that. So let's say you want to buy a call option, but you want to play it very, very safe, and you're looking to buy in the money call option. So let's say we buy the $392 call option for expiration date February the 26th. What you do is you click on the plus sign, make sure it's on buy plus, and then it's going to give you this format. So long call, expiration date up here, expiration date up here, the strike price up here, and then it's going to say call and buy, and then it's going to give you the total cost, which the market price, it's showing us $1.75. You continue, and then when you click on one contract, it's going to tell you the max cost is $175. You might be asking yourself, where did that $175 come from when it's only saying $1.75? Well, if you guys remember when I said a option contract is the right to buy 100 shares at a given strike price before the expiration date. So you have to multiply this number by 100. So $1.75 multiplied by 100 is $175, and that's what you pay to own one contract for the $392 call option for the expiration date February the 26th. So that was in the money. Let's say you want to buy out of the money because you can't afford it. Let's say you buy the $395 call option, which is out of the money. You click on the plus sign, you continue, and then this contract, to own one contract, it's only going to cost you $57. But in my words, it's going to be a little bit more riskier than that in the money contract. So we're going to cancel this, and we're going to go back to the $392 call option. You can also click on the actual, strike, and all of the information for that call option will open up. So for this call option, we have the bid, the ask. You got to remember that there's the buyers and sellers. You have to buy a contract off of somebody else, and you have to sell a contract to somebody else. You can't just buy and sell to the broker. You can't buy and sell to the Robinhood. So the bid represents the buyers, the ask represents the sellers, and looking at the current market price, which is $1.75, there's 150 buyers wanting to buy at $1.72, and there's only 50 sellers wanting to sell at $1.77. And then looking at the volume, today, about 44,177 contracts were traded. And then the open interest represents how many contracts that haven't been executed. So today, as of today, there's about 21,028 contracts that weren't executed. That's a lot of, that's a whole lot of volume in open interest for, one contract. And then over here, these are the Greeks. This is the delta, gamma, theta, vega, rho. The only two Greeks that I say that you worry about is the delta and the theta. You don't have to worry about the gamma, the vega, and the rho. So the delta, this helps you calculate how much profit you make for every dollar that SPY goes up by, and how much you lose for every dollar SPY goes down by. And then the theta represents the time decay. So this number is going to help you calculate how much the premium price is going to burn off for every day that you hold this contract. So let's say tomorrow morning, which is Thursday morning, you buy this $392 call option for expiration date February the 26th. And let's say after you buy this contract, SPY goes up one whole dollar. If it goes up one whole dollar, you made a total of $48.30. You just got to remember you multiply this number by 100 because a regular option contract is the right to buy 100 shares. So if SPY were to go up one whole dollar after you bought this contract, you would make $48.30. And then let's say SPY decides to go down one whole dollar and it goes down to $391.51 after you buy this contract, you lose $48.30. And then this is the theta. Like I said, theta represents a time decay. It's this is the hypothetical number that this number should lose for every day that you hold this contract. So for every day that you hold this contract, you should be losing about $46.55. And that negative sign is always going to be negative. It's never going to be positive. It's because the time decay takes away money as you get closer to the expiration date. So that was a call option. And now let's look at a put option. So we're going to change it to puts. For a put option, it's actually opposite for the in the money versus out of the money contracts. So when you're looking at in the money for a put option, anything above the share price is considered in the money. So 393, 394, 395 is in the money, and anything out of the money would be considered anything below the share price. So 392.5, 392, 391 is out of the money. And like I said, in the money contracts are going to be much safer, but they're more expensive. So, as you go further in the money, the contracts get more expensive. So, this one's 589, the one above it's 653. And, as you keep scrolling, they get more and more expensive. But anything out of the money, it's much more riskier. So the contracts are more affordable. So, as you get further out of the money, the contracts are very, very cheap. So let's say before the expiration date, still looking at February the 26th, which is on Friday, you're very bearish on a stock and you think the share price of SPY will be coming down. And let's say you want to play it very safe and you want to buy in the money in the money put option for SPY. Let's say you're looking at 394 and we're going to open up the information for it, click on the plus sign and continue. So let's say you want to buy one contract for the expiration date of the 26th of February for the strike price of 394. And one contract is going to cost you $312, and $312 is the market price. So looking at the bid and ask, the bid represents the buyers. So, there's 16 buyers wanting to buy at $3.07, which is about $307. And then there is about 6 sellers who want to sell at a price of $316. And then looking at the Greeks, the delta is negative for put options. In a call option, the delta is positive, but the delta represents a number for every dollar that a certain stock goes up by, right? But for a put option, since we want the stock to go down, that number is going to be negative. So for every dollar, since it's inverse, after you buy this $394 put option, for every dollar SPY goes up by, you're going to lose about $68.81. But for every dollar SPY goes down by after you buy this put contract, you're going to make about $68.81 in profit. And then, like I said, the theta is always going to be negative. That number, it never turns positive. So this number is the hypothetical number, how much you should lose for every day that you hold this contract. So, you should be losing about $39.47 for every day that you swing over to the next day. All right, so we talked about the put options, the call options. We talked about the bid, the ask, the volume, the open interest, the delta, the theta, Now I'm going to show you an example on Roku. So Roku is the same thing. Trade Roku options, and like I said, SPY is the only stock in the world that has 3 expiration dates in a given week. Any other stock is 7 days a week, or not 7 days a week, 1 expiration date per week. So the next one after the 26th, it's March 5th, which is next Friday. So let's say we're looking at a call option. For a call option, anything in the money is considered below the share price, and then anything out of the money is considered above the share price. And then for a put option, anything in the money is considered above the share price, and then anything out of the money is considered below the share price. All right, so it's the same scenario. Let's say you want to buy in the money call option for expiration date February the 26th. You click on the 405, click on the plus sign, continue, click on one contract. One contract is going to cost you about $1,400 and about $1,405. And then you have the bid, you have the ask, you have the delta, you have the theta. For this contract, for every day that you hold, you lose about $200. So that's why I recommend, unless you're certain for sure that the stock is going to go up after hours, don't just swing anything, and that data is going to burn away at your premium. And for this contract, delta, for every dollar Roku goes up by, you make about $66.24. And then when you're looking at a put option, change it to puts, looking at expiration date the 26th, you buy in the money put option. So let's say you buy a 415. So we click on the plus sign, continue. One contract is going to cost you about $1,000 and about $1,010. So you click on the information, you have the bid, you have the ask, the delta. Once again, it's negative for the put options. The theta, this one, it's always going to stay negative. This contract is going to lose about $236 for every day that you hold it. And the delta is going to be negative for every dollar it goes up by, since in a put option you want the share price to come go down. So that's how you buy a call option versus put option. And I talked to you guys about the delta, the theta, but I think that's about it, and I'm going to wrap it up. Thank you guys so much.